Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Hi, Will. How are you?
I'm doing well. It's kind of interesting out here in Ohio right now. We keep getting these false changes into fall, and then it heats right back up. So we're
Yeah,
kind of
no,
moving back to
yesterday it
fall.
was like 95 degrees in Columbia. It's supposed to be 95 again today, before really falling at the end of the week. But yeah, it's been hot.
Yeah, it's that temperamental shift into fall, I guess. We're
Yeah,
getting
and
into
what a
that.
time for a heat wave when Farm Science Review's going on in London, Ohio. I think
Yeah,
you're getting
yeah.
ready to head out there, aren't you?
Yep. So right once we get done recording, I'm gonna get some other work done and then head out to Farm Science Review. It's my first one, so I'm pretty excited for it. Get to see
Nick
what
and
they all
Nick
have.
and the guys and Nate, they all do a wonderful job with Farm Science Review. It's one of my favorite events of the year. Very similar to some of the other farm shows that people in other states might be familiar with, but Farm Science Review is a well done farm show. It's a great product.
A little shameless plug there. If you want to check out more content on Farm Science Review, you'll have that on Brownfield from Amy Simpson and I. So keep an eye out for that. All right. Well, now that we got that out of the way, thanks for teeing me up. What have we been seeing from the markets coming into this week?
Yeah, so largely a drag on all commodity markets across the board as we kind of head into the Federal Reserve meetings later this week and some of the other economic data that we've been getting. Corn for December down 18 cents to 678. Soybeans in November down 27 cents to 14.61. Those soybean components, soybean oil fell 3 cents per pound for October. Soybean meal was down $1.60 per hundredweight. Or per short ton, sorry, $1.60 per short ton. Old crop wheat in December down 28 cents to $8.30, and new crop July wheat down 25 cents to $8.50.
All right, so some interesting adjustments there. What really have been the key factors the last few days leading to those
We
changes?
had, yeah, so we had several this last week, and I'll try to go through these rather quickly. Spend a little bit of time more on some of the production numbers as we get combines rolling, get some more data coming in about U.S. crops. Ethanol production decreased 8 million gallons last week, down 6% from the same week last year. U.S. gasoline demand fell 10 million gallons last week and remains 12% below the same week a year ago. That kind of signals this broader economic concern out there as gas prices have fallen, but people haven't returned to driving yet. U.S. weekly export sales did return after a 4-week hiatus due to technical issues. Reported weekly sales totals released the first 8 days of the marketing year weren't flashy. They weren't depressing, but they weren't anything special. The National Oilseed Processor Association reported their members crushed 165.5 million bushels in in August. That was down from July and down from pre-report expectations. Open interest futures and option positions of Chicago wheat were flat on the week, but corn and soybeans were down 4% and 7% respectively. Managed money positions decreased for Chicago wheat, but saw increases for corn and soybeans. U.S. weekly export inspections were up week over week for corn, soybeans, and wheat, but down week over week for grain sorghum. All were within pre-report trade expectations. And then getting into some of these production numbers, 40% of the U.S. corn crop is rated mature and 7% harvested so far. The national corn conditions rating was down 1% again this week to 52% good to excellent. So we continue to see that rating kind of decline. 3% of the U.S. soybean crop is harvested, down slightly from 5% normal pace. The national soybean rating also declined a percent this week to 55% good to excellence. 11% of the U.S. cotton crop is harvested right on average pace. However, we had that historic abandonment in the cotton crop in the Southern Plains, especially Texas. 24% of the U.S. grain sorghum crop has been harvested, basically normal for this time of year. Grain sorghum conditions are rated 20% good to excellent, down 27% from what we would consider a historical average. So a big drop in grain sorghum conditions. And then on the wheat side, 97% of the spring wheat crop has been harvested. Right on pace with normal. And then we have started winter wheat plantings. 21% of the U.S. winter wheat crop has been planted as of date. And I love winter wheat. It's a great crop.
Well, we have to go at least every other week talking about it, just to keep it.
Yeah.
But I really want to start off today's discussion around harvest because we are getting that rolling. And, you talk about soybean harvest is just a little bit behind. Some others are about on pace. But last week, we talked a lot about the market tightness out there. As we start getting, further and further into harvest, how much do you think that's going to start being reflected within the market? How much of an adjustment might you see?
Yeah, good question. So as we start getting these yield monitor reports, or what I call combine yields, so these are taking grain to the elevator, selling it across the scales, or just reports of what people are getting off their combine monitors. I think that'll start to it already is, and it's going to continue to bid into trader expectations. There's been a lot of assumptions about what the crop looks like out there through tours, through satellite imagery, but the true test is ultimately always the combine monitors and going across the scale. So as we get more and more of those in, it's just going to either validify or shock the market. My expectation is that this crop continues to get a little bit smaller as we work through harvest on both corn and soybeans. And I think we're already starting to see that validated by combine monitors.
Well, a lot of the conversation this growing season was, talking about the drought out west and then a lot of rainfall in the eastern corn belt. So maybe on a more localized basis, what do you think is going to be a little bit of the breakdown? Are we going to see a lot of farmers in the east in a better position than in the west?
So yes, I mean, on a basis, or on a basic level, the folks in the east have a better crop than the ones in the west, just due to drought conditions. My inclination so far is that we had a very good season for vegetative growth in the east, maybe not necessarily for pod fill or ear fill. As we worked our way through the kind of the pollination phases. So I think the crop largely looked good from a satellite imagery and from a vegetation index, but certainly I don't think the yield's quite there in the east. Reverse of that, we had all this drought concern in the west. Low yields are going to be low, and they're not going to be good in the west. Sorry, did I say east earlier? In the west, I meant the drought in the west. The plains states, basically. So there is a drought in the southern plains. There has been, it continues to be there. We might see actually a little bit better yields than what we anticipated out of that west. However, it is coming from a low base, and it's not near enough to make up for what I think is going to be the decline in the eastern corn belt, given the acres that we have in the eastern corn belt. So overall, that's why I think this crop continues to get a little bit smaller. Is very strong vegetative growth in the east, but maybe not the pod and ear fill. And then maybe just a slightly better yield in the west, but smaller acreage. And again, we're starting from that low base.
It sounds like you might be watching a little bit too much SpongeBob. It's like, did you say the east? I thought you said west. No.
Yesterday, so real quick, a hiatus here. So yesterday, I get a daily pun. I have a little calendar. It sits right next to my coffee pot. I have a daily pun. And yesterday's pun was, what does wheat have in common with the sun? And the answer was, it rises in the east and sets in the west. And
there you go. Yeah, it's both cringy and funny if you don't.
Yeah, that's right. That's what I thought to go.
But talking about general market factors as we look ahead, we have some things that are maybe driving trade and then also some domestic values. So looking at currency adjustments on the global market, what is that really doing to export values right now? How is the U.S. sitting?
Yeah, so the U.S. dollar index continues to strengthen. And again, that dollar index is representative of a basket of currencies around the globe. I think, early on, you and I maybe had multiple conversations. Traditionally, when we've seen that U.S. dollar index increase, it's been kind of a headwind to U.S. trade. We didn't necessarily see that during, the early parts of this year. We're starting to see softer sales now, but I think that's due to a couple of other factors. The drag in the economy in China due to their real estate crisis and just slowing economic signals in China. But also we're seeing countries like Argentina promote programs to bring 200 million bushels of soybeans to the market, the export market as well. So I think those are kind of also in play here, is why we've seen some of this softer trade sales as of late. But then I went in and did a dive. I mean, while the U.S. dollar index relative to this basket of currencies is, traded above 110 last week for the first time in 20 years, you look at some of these other important currencies to U.S. exports, like the Mexican peso, for instance. The one U.S. dollar transitions to about 20 Mexican pesos, and that's about the same since the early part of 2017. So not huge swings there. When we look at the Japanese yen, it has increased just slightly in 2022, but historically has remained relatively flat since about 1988. So we've been in this long period where that's not changed much here in 2022. The U.S. dollar to the Canadian dollar is slightly up in 2022 as well, but also remains flat compared to our normal historical long run trends there. And then finally, the U.S. dollar to the Chinese yuan. I don't know if I said that right. Yuan.
I think it's yuan.
Yuan. Thank you. The Chinese yuan is about the same today as it was in 2019. So keep in mind, we had a very strong export year in 2021 due to some of these other things. And we really haven't seen that change as well. So, at least in terms of our major buyers, Canada, Japan, Mexico, China, those dollars have remained relatively stable, but it's our competition, right? So when I look to one of our big competition sources, especially for corn, Argentina, the Argentina peso continues to rapidly decline. It's trading at 144 pesos to $1, whereas just as recently as 2018, that was 18 to 1. So a drastic reduction in the Argentine peso, which makes their goods cheaper on the world market.
A little bit more competitive. Yeah. So that could, I guess, potentially cause a little bit more market share to go toward them specifically there moving forward.
Yeah.
Looking elsewhere on some general economic factors, we have a Fed a meeting coming up here shortly. Looking at all the turmoil and the adjustments that we've seen around interest rates, are you expecting anything big as far as market moving ideas coming off of this meeting?
So the Fed is meeting this week. They'll announce their short-term rate position, whether that's the same, decline, or increasing on Wednesday. My expectation is very in line with the market. The market is currently projecting an 82% chance that the Fed will raise interest rates, short-term interest rates, 75 basis points to a target of 3 to 3.25. The market's also giving it an 18% chance that it goes a full 1%, up to 3.25 to 3.5. The reason I say I'm comfortable with that, and I think the reason I expect that, I'm comfortable saying that's what I expect, and also that there's an 82% chance that the market believes that that'll be the target, is all year long, the Fed has telegraphed communicated their planned interest rate hikes through their meeting minutes. It has kind of been an interesting way to kind of signal their direction on interest rates. And so I don't look for them to go against what they put forth in their meeting minutes during their last meeting, that they plan to keep this environment going forward. And certainly, the Fed has said that they need to see inflation and especially wage rates kind of moderate before they start thinking about, tampering back those increases or even decreasing it a little bit. So I do think we're continuing in this increasing interest rate environment. It'll make short-term rates, more expensive, and it'll transition into some longer-term rates on the back end as well that are set by the market. And certainly we've seen mortgage rates, reach, higher levels as we've moved through this environment as well.
So I got a quick question here. Are you an economist or a weatherman?
No, I'm neither. No, just kidding. No.
I was going to say, it sounded like you're a bit of a both there for a minute, talking about 82% chances. But no, really looking out throughout the rest of the week, are there any other reports, any other things that farmers should really be watching that could drive the market one way or the other?
Yeah, outside of our normal ones, that Fed meeting that comes out on Wednesday in terms of their short-term interest rate expectations. And then we get a cattle on feed, which again, our colleagues Megan and Scott talk about thoroughly, but just something to be aware of as we think about what that could mean for corn demand over the next couple of months.
All right. Well, if any listeners and viewers would like to check out more of what we've been doing, you can do so at brownfieldagnews.com. As Ben just mentioned, also check out our counterparts on the weekly livestock market update. That's Megan Grebner and Scott Brown at MU. Thanks, Ben, for joining me today. I'm Will Robinson on Brownfield.